Okay, it's time for our Microcap Fund Manager interview series to get back on track. Been a while since we did one of these, but I'm delighted to welcome back Luke Winchester from Merewether Capital. Luke, how are you going, mate?
Good, mate. Good to be back.
For anybody who didn't see you the first time around or hasn't seen you, I guess on Osbiz or anywhere else, maybe give us a quick overview of Merewether Capital, style, where you play in, is it retail, wholesale? Just kind of give us a quick overview of the fund.
Yeah, no, you're right. I've got my face everywhere at the minute, here in Osbiz and all different places. Yeah, Merewether Capital, we run the Inception fund. So it's a pure microcap fund. The mandate's quite open, but from a more focused point of view, really looking from that 20 mil to sort of 200. I think that's a real sweet spot. And even within that, I sort of really like to target around probably that 100 to 150 mil, where you're finding genuine businesses revenue usually through that scale to profitability and cash flows, but at that size still below what you'd call the more institutional larger funds. And as stocks grow and get onto their radar, microcaps grow up to become bigger companies. There's plenty of those that we're all trying to hunt in that sort of ground. We are a wholesale only fund. Just that's quite a prohibitive cost to be retail. So being a small fund allows you to be nimble in the microcap space. So you don't really have the size to run a retail. Like I said, that creates the opportunities to play in the space where we want to find those great little businesses.
Yeah. And we've got two we're going to discuss today. Now, post-reporting season, it's an opportune time to maybe to run through. The first one we've got is Vysarn. Probably not as that well known of a stock. I don't think hasn't been listed for too long. Give us, kind of the 101 in Vysarn, for people who maybe haven't come across the business.
Yeah, you're right. So it only listed back in 2019, I think August 2019. Had a bit of a funny listing. It was a backdoor listing from a mining company. And basically the business was founded by a guy called Peter Hutchinson, who was previously the MD at Forge Group. Forge Group, of course, didn't have the most spectacular end to its listed life, but Peter had already moved on by that time. He was sort of responsible from taking it from a micro cap to a much larger business. And what he did was bought some assets from Ausdrill, which is now Perenti, more specifically some hydrogeological drilling, which you probably colloquially will just see that as dewatering. You'll see mine sites often having to dewater, and that's the drill rigs that Vysarn went and purchased. So purchased those assets, now had an operating business, backdoor listed that into Vysarn. And listed life was a bit tricky for them. So WA-based business, COVID hits, like a lot of businesses over there. All of a sudden, labour pressures, borders were closed. Of course, things kept running, so results were okay, but the business was sort of not quite running at scale. Rigs were moving in and out from different customers to others, and just little bits and pieces where the business sort of underperformed even its own expectations. They had some guidance out in the market which they missed, which that's the death knell for a microcap business. You sit in the sin bin for 6 or 12 months after something like that. So that always creates the opportunity, though. So I had it on my watch list for a while. I'd spoken with James Clement, the MD, and had sort of gained a bit of confidence that those headwinds were really starting to ease, the COVID headwinds, but also some of the self-imposed headwinds where they had actually taken some of their drill rigs out of the field to spec them up, to put them into a new contract they'd won with BHP. And that was going to be quite exciting because they were going to be at higher rates and the potential to double shift those rigs. So, speaking to the business and also in their communication as well, they'd sort of flagged that the first half of financial year 23 was going to be okay, but not spectacular. But you're really going to see that business start to shine in the second half. So they actually came out twice before that and sort of upgraded guidance a couple of times and then hit some spectacular numbers. So that's sort of the business and how they got to where they are today. But yeah, let's dive into some more.
Yeah, so maybe if we just carry on that thesis. I mean, yeah, anybody who knows the kind of odds drill business or likes of, it's all about rigs on the ground, utilization. It's do or die on kind of utilization. But is it more the investment thesis that they can now start expanding? That we're not in lockdowns and all of that, so that kind of self-imposed, let's just keep what we have here now, and we can now really start to look at expansion, that they're not hindered by all these COVID regulations, and they can kind of start executing on the original strategy, if we want to say that.
Yeah, no, fantastic point. And so you really nailed the thesis there. So when we say mining services driller, most of the time on the market, we're talking about an exploration focused driller, like a Parenti, a DDH, Mitchell Services, Dynamic Drill and Blasting. And it's very much a utilization game. It's how many rigs do you have and how many can you put in the field at any one time? And when you have to move rigs from miner to miner, explorer to explorer, can you minimize that downtime and just keep that utilization high? So that sort of, I think, creates the opportunity in Vysarn, because that's the stigma that gets attached to it. And those businesses naturally attract low multiples. They're capital intensive. They're very cyclical. They're at the mercy of these, larger customers on the production side, and then the cyclicality of explorers on the exploration side. So when I first spoke to James at Vysarn, what really interested me about the business is he didn't want to play that game. So they had 12 rigs, and the plan was to keep that at 12 rigs, have all 12 of them in the field at max utilization at all times, and harvest the free cash that came out of that. And look to acquire and organically expand into a diversified water services business. So underpinned by this dewatering drill rigs, it does share some of those characteristics. It is asset intensive. There is some capex behind it, but nonetheless does spit out good free cash, and able to take that and look to get into some sexier areas, I guess, of water services, higher margin stuff, a bit of IP behind what they're doing. So that's what really interested me, and I think creates and still does create the opportunity in Vysarn, where the multiple trades alongside some of those more traditional mining services peers, whereas the fundamental economics of Vysarn is completely different because of the way that they're not reinvesting back into their fleet. They're not looking to expand it. They're looking just to run that as a steady state and get into some more new and exciting areas.
Yeah. And I mean, yeah, that maybe leads on to my next question about, risks around the business. I mean, obviously there's the rigs that kind of 100% fully utilized strategy doesn't play out as they wanted, and the cash flow comes off. And then I guess on the other side, you got a back management to branch off, buy something, develop something. It's in-house development of another section of water services, and can they execute on that? Is that kind of where you see the risks, or is there something else that you're kind of thinking about maybe?
No, again, you've absolutely nailed it. The main risk is that, as we sit here today, the vast majority of earnings comes from the dewatering rig segment. Now they've tried to minimize that risk as much as possible. We're talking about 12 rigs that are out with Roy Hill, Fortescue, and BHP. So there's very little risk of anything happening to those businesses. They're on multi-year contracts. So again, de-risked it from a commercial point of view as much as possible. But you always just have the ad hoc risks of rigs breaking down or something happening, and that just can't be avoided. So it comes back to execution risk around the rest of the strategy, and I think that's where the business has performed really well over the last year or so. Share prices perform well at the same time. But I still think there's an immense opportunity for these guys. They're only scratching the surface. And what gives me confidence is that the execution so far has been really strong, both, as I said, organically and through M&A. So They've acquired twice, and both of those acquisitions have outperformed expectations. One of them actually sensationally so, a business called Project Engineering, which does aquifer recharge technology. When they acquired that, they expected it to do 800 to 900 profit before tax for the last financial year. It did about 1.5 million. And they acquired that and another business, but they also organically created a consulting business from the ground up. I think that's now up to about 20 odd employees. Started that from scratch only a year and a bit ago. And that was a segment that was originally supposed to run not as a loss leader, but roughly as a break-even type business, and to help them get at the pointy end of projects, and you're up there up front with your customers, finding out their needs and projects before things happen, and then obviously bringing in with the rest of your diversified services afterwards. But it's actually been such a successful segment that it generated $600,000 profit as well in FY23, and growing exceptionally quickly. And of course, it's one of those sorts of segments in that sort of professional services consulting segments where you do get a genuine flywheel, because if you are attracting good people and being involved with the best projects, that wants more people to come and work for you, which helps you win more work, and it just creates a nice flywheel. So they're starting to see the benefits of that. And it all ties to the relationships they built through that dewatering segment. As I said, you've got a water services business that's working alongside BHP, Fortescue, and Roy Hill every day, and you're able to constantly, through your consulting arm, ask them, where else can we help you? What are you thinking about next? Be that infrastructure, pipelines, aquifer recharge, all these sorts of things. So, it's quite exciting. They'll have their AGM coming up in November, but for anyone interested, if you go back to their last AGM, I actually thought the presentation they gave there was extremely helpful, where they have a really good diagram of the overall industry. They break it into a pie chart showing where they play currently and where they think are the best opportunities to look at for the future. But there's certainly some bold ambitions, looking to get into infrastructure, pipelines, like I said before. That's all very early stage, but nonetheless, I think James and the team, they've got their heads screwed on and really think about things quite strategically and thoughtfully, which is really good.
Okay, and if we look forward, what are you looking for them, to kind of come out with announcements? Is it, a bit of an update at the AGM, or expecting, to do another kind of little M&A deal that, brings in another little division, or helps to kind of scale, something that they've already got, buying a small competitor like Bolt On. If we're looking over the next 6 months, kind of what are you expecting, because the results are out now, so are you expecting anything kind of really major to come out in the next 6 months?
I think you've summed up the two things that could potentially come out. So one would be a small acquisition. The balance sheet's in very, very good shape. So there's no corporate debt. They finished paying off their corporate debt back in July. There is some asset finance there, given, tied to the drill rigs. And there's 8 mil cash in the bank. So the balance sheet's in a really good spot for some M&A, and even some larger M&A if something was on the table. What that would be hard to say. Like I said, they've got quite a large industry that they think they can attack, and what would work into what they already have. But I think what you would hope to see over time would be an expansion over to the East Coast. Right now, very WA focused, and of course, the mining exposure makes sense there. But water services is huge for agriculture, farming, and also mining over here as well. So plenty of opportunity for them. So M&A definitely. There should be an update at the AGM. They've done that in the last two. Usually that's a guidance, which would be nice to see. Maybe a trading update or guidance. But what I would like to see is, as I said before, that core drilling segment had the weaker first half, but a really strong second half. And when you annualize that second half, you get a nice strong run rate into FY24. So you'd hope to see guidance at least matching that second half run rate. If not, obviously some growth on top from the other segments that will provide the growth. So yeah, that's what you'd be keeping an eye out for, and fingers crossed AGM will get a nice healthy update or some strong guidance into FY24.
Okay, we'll keep an eye out for that. And then second one we're going to talk about is Prophecy. Now, this is a business that has been listed for many. You'd have to go back a long way
Yeah.
to find when Prophecy first listed. But yeah, for anybody who mightn't have come across it, maybe just give us a quick 101 on Prophecy.
Yeah, so Prophecy's a software business. Has two main software modules within that. So first one is eMite, which is a call/contact center analytics software. And the second one is Snare, which is a cybersecurity monitoring tool. So not exactly the keep out bad people, but it monitors your infrastructure and systems and basically, checks for intrusions or monitors data and things like that. So yeah, it's been listed for a very long time. I think 1998. So, in the peak of that .com bubble, which
Yeah.
ended poorly in those first couple of years. But again, so go back to when I was talking about Vysarn and I mentioned that I think the opportunity for Vysarn was created by the stigma of mining services being attached to it. It's a question I like to ask myself, why does the opportunity exist? And what you touched on there is, I think, part of the answer for Prophecy, which is it's been listed for a very long time. And you look at the share price chart and even the fundamental revenues, profits, it's bumbled along for quite a long time and acquired staff, spun them out. And I think the market naturally looks at the business and says, well, if you've been around for 25 years and haven't made it yet, like why now? And that's a valid question to ask. And so I think if you have a good answer to that question, that creates the opportunity for investors. So when you dig a little bit deeper, I think Prophecy is a very interesting business where the transition from perpetual licensing as a business model to recurring subscription income, it's happened quite a lot, and we've seen it across the ASX. Objective Corp did it, Technology One did it, RPM Global did it, and nonetheless, as investors, even though we know a business is going through it, we still struggle to get our heads around how bad the numbers look in those years while it's happening. So to better explain it for people, these businesses used to sell a license to use their software, and they would recognize 100% of the revenue and cash upfront. So a business might pay for a 3-year license to use eMite or Snare, and Prophecy would collect all that upfront and recognize all the revenue upfront. When they go to subscription revenue, so on average, Prophecy charges about 40% of the license. So let's say it's a 3-year license, you would only get 40% of that upfront, and then 40% the next year. And it's not until that 3rd year where the economics start to stack up. But of course, 4th, 5th, 6th, 7th, 8th, that recurring really starts to build. And I know I'm not talking about it today, and it's starting to migrate out of our microcaps, but RPM Global, if people have a look at their last report, you really see that operating leverage once you get through that transition open up nicely and profits come through. So anyway, Prophecy went through that with eMite a few years ago. They've come out the other side. eMite's revenue is now essentially 100% recurring. And then just as the numbers started to look good, they made the transition with Snare. And so now Snare's going through that same process and again, making the numbers look a bit muddy. But nonetheless, looking underneath that, I think there's a core business and a core revenue base that's growing quite well. And where you see that is in the annualized recurring revenue. That's a CAGR of about 40% for the last 5 years. They've taken that from essentially nothing. They were, zero recurring revenue to now 23 million at the last report. So that's that recurring base that's building. And of course, it takes time and there's costs invested ahead of that. But nonetheless, that's the Prophecy thesis in a nutshell. And I think it really stems from over the next year or two, seeing the true economics, I guess, of that SaaS business really start to shine through, which is still being unfortunately muddied a little bit by the perpetual stuff right now.
Yeah. And I mean, you mentioned AIR, and we saw a lot of tech businesses bring on a lot of revenue, and they can say it's month to month, recurring there. But kind of post COVID, we've also seen the graphs that were going like that starting to turn or go sideways at best, and now you no longer have these high growth tech names. Is that a risk for for Prophecy, or where do you see the risks in their business? I know the change in revenue and billing model is kind of muddying the waters, but if we step back from that and just look at the business, because they generally, from what I remember, deal on the enterprise level. It's like with big corporates, the ATO, I think, is one of their main customers, if I remember correctly. One of them drifting off and pulling 600 or 700 users with them, it's going to have a big impact on that AAR line.
Yeah. Churn's always a big risk for software businesses. Prophecy doesn't disclose a churn. That's a criticism I've provided them in the past. It's been such an interesting couple of years for tech businesses, and you're exactly right. You saw this real hyper growth come for a lot of tech businesses through 2021, and then that growth slowed immensely through 2022, and then you really saw a lot of cost inflation hit businesses as well, and Prophecy wasn't immune from that. So they've seen somewhat those effects. So ARR grew 40-something%, I think, in FY22. That slowed to 26% this year. So you've seen the slowdown, like a lot of tech businesses, and the same commentary from Prophecy that you heard from a lot of people, which is that sales cycle really lengthened. So previously, where you may be able to get an enterprise to sign off at a area manager or a group manager, it now has to go to the CEO or the board, or there's more eyeballs and more signatures on decision making, and so it slows that process, and enterprises can be quite bureaucratic at times. So then combine that with cost inflation as well, and so again, Prophecy not immune from that, and I think it created a bit of a fear or a worry that was Prophecy no different to a lot of these tech peers you were just talking about, where growth has slowed, but the cost base just keeps ballooning and the losses expand, and when will you ever see profitability? Again, I think part of that fear or worry stems from that reporting change I was outlining before. It does still muddy those numbers a bit. But the other part of it is there was just genuine cost inflation for tech businesses. We saw a lot of that reported in the media. The salary inflation for good developers and good salespeople in tech was quite high. And that's best outlined by Prophecy. They saw their employee bill go up by 20-something% year on year. Yeah, their headcount was essentially flat. I think it was maybe a handful of extra people. And there was some moving factors to that, but the biggest one was quite honestly, and Brad, the CEO, outlined this on a call, was they had to pay a lot more to keep good people, and that was a similar theme for a lot of businesses. Now, that sort of meant that FY23 becomes a bit of that consolidation or transition year. You had a really good FY22, FY23. Okay, it wasn't what you expected, but you've now got through it. Sort of business was roughly cash flow break even, lost about $1 million, but 12 mil in the bank. That recurring revenue base is still nice and strong, still growth there at the top line. Can you now start to see that operating leverage come through? And I think, from what we've heard from Prophecy and other peers, is that tech wage inflation has moderated quite a bit as borders reopen and they're able to get skilled labor from overseas. That growth is still strong. They only signed the ATO recently, and a few other enterprise clients continue to onboard. So, I still think that you'll see some modest cost inflation, but definitely at a much lower rate from what we saw in FY23. And hopefully, as that revenue increases at a faster rate, you see that operating leverage come up. And on a recent call, it's not formal guidance in a presentation, but Brad publicly said he wants the business to be EBITDA break even this year, which, considering they don't capitalize any software development, EBITDA is a pretty good proxy for free cash flow for this business. So I'd expect them to be cash flow break even and EBITDA break even. So that's the sort of the thesis there.
Yeah. And so in terms of what we should be watching out for looking at, Prophecy over the next 12 months, we're not expecting any kind of M&A here. They're not going to try and pull in, a niche provider that's going to complement EMI or Snare. It's more, the transition on the snare side to recurring revenue, still see that coming through and building, and a bit more of a moderation on the cost side, which should hopefully all start dropping down to the bottom line.
Yeah, they've been quite candid. So, as I said before, the history of the business was one where there was quite a lot of M&A, acquiring businesses, spinning them off, and that was done a lot. And so the decision was made 5-6 years ago to focus the business onto the two good segments that they had, which was Emite and Snare. And so I'd be very surprised if they, were to then go back to that path of M&A, unless it was something that was a nice strategic fit alongside one of them. But I'd be a bit of a thesis breaker to go and see them acquire a completely, separate software module. So as far as announcements, I mean, what you'd expect to see from Prophecy, hopefully, is some more contract wins. As they get larger, they're not announcing more of the smaller stuff. But if you have a look, they sort of announced the ATO recently, which was sort of 700, 800,000 ARR. So, around that sort of size, where you're tacking on maybe a few percent to your ARR base would be announced. So you hopefully see a few more of them. On the Snare side of the business, yes, building that recurring base is what you want to see, but their government and defense customers still prefer to transact on a perpetual basis, mostly because of tenders. It's easy to tender into a CapEx budget rather than OpEx budget. And on that front, Brad, the CEO, has said publicly a few times there's some very, very large US government tenders that they're currently they're part of a consortium to. So fingers crossed, landing one of them, I think would be really nice. And obviously a very good validation for Snare to be part of a US government consortium. And then, similar to Vysarn and most other businesses, the next operational update would be the AGM. They usually do a first quarter update around that AGM sort of time. And you'd hope to see the business, tracking towards that EBITDA profitability, revenue going the right way, and really seeing that operating leverage starting to open up. So that's what I'm sort of looking at for Prophecy over the next few months.
Okay, great. Luke, thanks very much. I think we leave it there. I think two good stocks for people to throw on a watch list or do a bit of a deeper dive on. If anybody wants to find out more about the Inception Fund and Merewether Capital, what's the best place to do it?
Yeah, merewethercapital.com.au. Jump on the website. I've actually got a blog post about Prophecy on there, so if anyone's interested by that, have a read. And on Vysarn, I don't have anything written about Vysarn, but a young guy called Ben Sayers actually has a write-up on Claude Walker's A Rich Life. So if anyone's a subscriber to that, jump on, have a read of Ben's work. He's, like myself, got to the story quite early and done well out of it. So congrats to Ben, and he's done some good work.
Okay, great. Luke, thanks very much. And hopefully we'll get you back on maybe in another couple of months.
Awesome. Thanks, mate.